following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
And welcome back to Volatility Views, your weekly source for news, information, analysis, and opinion from the world of volatility and volatility trading. My name is Mark Longo from the OptionsInsider.com, as well as the Options Insider Radio Network. And my usual cohort, my usual companion on the show, Don Schlesinger from Volex, was called away at the last minute to attend to some pressing family matters, but we have a very game and able replacement stepping up to the plate to pinch hit at the last minute. He is Bob Kraus. You know him from our epic croquet courtside episode from last week. Coming back to step into the void yet again. Bob, welcome back to the show, sir.
Oh, thanks, Mark. Yeah, I'm still recovering from that wonderful week down in Florida. But
and from the sight of watching those Boca folk play croquet back and forth while we were recording that episode, I could see your eyes. You were transfixed by the spectacle unfolding in front of you.
Yeah, they were really good. So, I was very interested in the game. So.
Mark, you're a big old cake eater, so it probably worked out really well anyway, right? They handed you your tea, your crumpets. You had your high tea. Then you had your, Bob and you played some shuffleboard after the fact. You know, I always said Mark Longo, he's 35 in age, 75 in spirit.
Yes, that's me. I belong in Boca. I'm just sizing up my future home as we speak, and I have my croquet outfit all put aside. Listeners, of course, that is one Mark Sebastian from OptionPit.com joining us on the program yet again, sir. Welcome back. Sorry you couldn't make it croquet side. Of course, the weather here in Chicago wasn't exactly bad.
No, it was gorgeous. It was unbelievable, and I regretted it because any chance I get to sit down with my boy Bob Kraus, I'm always going to want to do that. Nobody knows how to duke it out over on vol discussions like Bob. He's him and Don are two of the best sources on the subject and really get it, which is a rarity. So
well, we got a great source coming up with Professor Anthony Neuberger. I can't wait to talk to him.
Oh, yeah. I can't either. That guy's going to be, He's
the Godfather.
Like the Godfather. He is.
Listeners, he made Mark Sebastian speechless just referring to him. So that alone should make you interested in hearing it. Of course, we are continuing our string of knocking it out of the park with Volatility Views guests, of course, with Anthony Neuberger, the man who in many ways kickstarted the world of tradable volatility products back in 1994 with his seminal paper. And we will be talking to him very soon. That'll be your tease, listeners. But first, we're going to dive right into our volatility review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, the portion of the show where we look back on the week's worth of action from a volatility perspective. And it was quite the interesting and action-packed week last week. Not even referring to that little quote-unquote hiccup we saw over at Bats, which tended to send the market into a tizzy, but that's not entirely an options or not entirely a volatility-related story, so we'll leave that for perhaps another show for another day. But yet an interesting one nonetheless, and caused quite the flurry of excitement in the old market. But Mr. Sebastian, what were you watching? Let's start off with the land of S&P volatility, aka the VIX, and what was unfolding in VIX land over the past week.
Well, we saw kind of what you and I have been talking about for some time, just the absolute slaughter of the VIX April future. There's a new pattern.
That one's been on the docket for a while. We knew something had to unfold there.
May is setting up to do the exact same thing. The ETNs are really putting a number on that month one, month two contango. We've seen just the VIX itself just get absolutely crushed. 15%, still relatively, still a premium relative to the market. But, S&P vol is trading, the last time we touched 14, we were there for a day. Into the 14s, we were there for a day. We've now been in between like that 14 and 16 range for now about 2 weeks. And there may be a 6-month pattern of just really low option premiums historically developing. Now, relative to the market, kind of a different story. If one is insistent on selling premium, the NDX vol with Apple kind of juiced up a little bit seems to be the better play. And of the indexes, Russell 2000 is moving much faster than the S&Ps and the NDX right now in terms of percentages. And it is relatively inexpensive compared to where its vol is trading relative to the other major indexes. So that's kind of what has been on the docket. If you want, we can get into the TVIX thing that happened. Credit Suisse released creation units and basically crushed every single long that was owning
did they finally open up
TVIX.
the books again?
Yeah, they did. And
that's funny because I had that conversation with some people last week about, is this thing officially closed or are they going to open it up again? And the consensus I got from people was that it's officially closed and now they're issuing creation units again. So there they go.
They basically,
wow.
Which is interesting, and that tells you Credit Suisse has either laid off enough risk that they're now willing to take on more than short 80 Vega, or they actually perceive that they want to be short more Vega. My guess is it's probably a little combo of the both. But yeah, you're seeing we're seeing new creation units, and we're seeing just that TVIX is now touching. It's gone from 13 to 6.5 in less than a week. So
talk about just artificial nonsense.
The guys that got 630. The guys that got to borrow TVIX and short the bananas out of it are very, very happy campers. That TVIX UVXY trade was the layup of the year if you could borrow TVIX.
This seems to be a trade that could have been gamed so easily if you had any sort of insight into what was going on over in the land of Credit Suisse, or just in general. To talk about just this just highlights what we talked about so many times about the dangers of some of these more esoteric structured products that are lurking in the VIX and volatility ETP world, and how if they're not structured properly or managed, in this case managed properly. I mean, this entire scenario was an artificial construct because of the way TVIX was so poorly handled, and they created this inflationary atmosphere where it decoupled from the NAV and was bit out of control, and a lot of people wanted to short it, but it was a dangerous play to do because you didn't know what was going on at Credit Suisse, and you didn't know if they were going to be coming out with new units or not, or if this is going to continue to decouple and be bid up. And yet it seemed like the prescient play was to short it, and of course it turned out that was the case. Yeah,
well, and there were a lot of, I ran into a lot of I want to let you know, people, I do not feel bad for any of the following people I'm about to mention. I actually think they deserve it. I talked to several traders that called me up on when the VIX popped last week on the China stuff. They called me up when TVIX was down $3, and they're like, I don't understand what's happening. Why am I losing money? The VIX is up, VXX is up. What's going on? And these are people that lazily bought the product and didn't do any reading on what was going on. We've known about this TVIX issue for 3 weeks. If you lost money on TVIX, you deserve every dollar you lost. Enjoy it.
Yeah, we had that same conversation on the option block when people were calling up OX, panic-stricken, saying, what's going on with my TVIX position 3 weeks into this unfolding debacle? If you got into TVIX 2+ weeks after this happened and you didn't know what was going on, then that really is your own bed that you made, and now you must lay in it.
Because a fool and his money soon will be parted. I believe that's what they say.
Exactly. But that, of course, just highlights, like I said, the risk of this ever-increasing world of volatility ETPs and all of the interesting nuances that emerge therein. Of course, you touched on NASDAQ vol as well. Interesting things going on in there. Bob, you have anything to add in the world of NASDAQ vol now that, of course, you guys are about to dive into the deep end of NASDAQ volatility?
Well, actually, I just put up all the charts for Eurovol, so let me talk about that first.
No, let me throw you off your game completely, and let's start with NASDAQ, and we'll go from there. No, I'm kidding. Go ahead. Euro, please. Well,
yeah, I mean, it'll just take me a minute to get the stuff up, but for Eurovol, we went off at 1094 for the 1 vol for March, and that was also the expiration for the 3 vol, and that went off at 1038. It was. Don basically has been saying for 2 months that, Eurovol is probably a short. I think Mark Sebastian agreed with him. And since...
in a rarity.
Since December, I mean, it was just straight down. I mean, we were up at 17, like, beginning of December, and we got down to, like, 9% or so. With the 1 vol and the 3 vol, and then we bounced up a little bit back up to probably about average again, right around the average mark around 11. So it was a perfect short at 17 for the mean reversion trade. When you got past the 10-11 mark, you should have started on the buy side because of the mean reversion, and then we popped back up by expiration right back to the mean. So this was like the classic and perfect mean reversion trade for the last quarter.
Yeah, it followed an interesting partially similar pattern to what we saw at the end of the year with VIX and volatility, where it just came off this perfect storm of structural events caused volatility to just come in astronomically, and then of course we haven't had that corresponding pop back to the upside yet. Everyone's still waiting for that, but Euro, it came off exactly the same way, this precipitous decline, and then despite what was going on out in the broader Eurozone, and then we saw this little reversion towards the end. So a very interesting pattern in the land of Eurovol. And you're right, if you've been listening to this show for the past few months and you came in to hit some of those bids in the old Eurovol contract, or one lot or whatever the case may be, you're doing all right now.
Yeah. So back to the NASDAQ. So the last month or so, it's been around 11% volatility, pretty darn low. And even the 3-month version is only 11.36, so just a hair over 11. So
yeah, that's a tough one to sell, even though it may be empirically the right thing to do. Still, it's tough to come in and just start hitting 11% vol in the NASDAQ. That would be rough, I think.
Yeah, absolutely. And the cone though for the NASDAQ is very interesting. The average volatility is just under 20, so like 18 or so, something like that. So at 11, we're at the bottom 90th percentile. What I also find interesting though is that some of the guests we've had on basically say that even though the option premiums are relatively cheap, they're still way too expensive when the market's rising. So it's a tough one to be buying volatility even at 11 at the 10 percentile on the volatility cone.
Yeah. If you look at those volatility cones, that certainly is a a difficult one to hit, and also yet you don't want to buy it in this environment either. So it's one of those difficult trades to jump in on either side.
It makes you feel like you should take that cone and just put it on your head and sit in the corner, right?
A dunce cap.
Yes, there you go. The seller don't sell perhaps will opt for the don't sell in that scenario to keep Don's spirit alive here on the show while he is away.
Hey, sold to you, Mark Longo.
I don't think even Don would be selling to me at a NASDAQ at 11 vol, perhaps, but I don't think even he is that aggressive.
Well, what I think will make some sense is to buying the NASDAQ realized vol against selling like a VIX contract could be a really, really interesting play. Those two correlate so well that you could really do something interesting like that, or even sell like an option strangle against that NASDAQ play. Because as I stated kind of a couple minutes ago, NASDAQ vol is the most overpriced of all the major indexes, and its realized vol just isn't there. It's been this kind of Apple lifting everything, but if you took Apple out of the NASDAQ, the realized vol would be even lower. I think this a fun thing. I've got homework for you, Bob. I want you to start calculating a NASDAQ with Apple and a NASDAQ without Apple, and I think that will be really interesting to take a look at. So if you think that Apple is going to slow down, which I do, you could conceivably buy this contract and sell option premium and scalp the difference. And I think that you'd really, really have something there.
Yeah, not only would that be interesting, we've been talking to a whole bunch of traders in the market, trying to gather momentum for the launch of the NASDAQ vol contract. And many people have said that they just love to trade this thing against the VIX, that even though it's NASDAQ versus S&P, and even though it's realized versus implied, they can just see a whole bunch of trading opportunities between the two.
That was one of the more interesting topics of conversation when I was at that risk management conference a few weeks ago, was just the various ways of interrelating these various vol products and having a broad portfolio, hedging with perhaps an SPX put, and then hedging that hedge with VIX upside or some other volatility product, and then constructing hedges of hedges with various products. It was a very interesting and tangled web people were weaving, but it was very interesting to watch. Oh, and speaking of the Apple point there, Mark, Bob, what did we decide? Didn't we decide you're going to call the NASDAQ products Apple Plus instead? That was the new marketing slogan we came up with.
Well, he means Apple minus, though, right?
Oh, for his sake, yes. But in general, for the broad public, you just call it Apple Plus, and I think you'll have a stampede beating its way to your door. But that's going to do it for our volatility review for this week. But don't go away, because we're about to dive right into our conversation with Anthony Neuberger, in many ways the godfather of tradable volatility products. So stay tuned for that.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
All right, and welcome back to the Volatility Viewpoint. And we are joined today on the show by a very distinguished guest, and you can tell by the background noise there that he's beaming into us today all the way from the UK. He is Anthony Neuberger, the professor of finance at Warwick Business School, and also the man who in many ways helped to kickstart the world of tradable volatility products. Anthony, welcome to the program.
Thank you very much. It's good to be here.
And I'm glad we can make it. I'm glad we had some scheduling difficulties last week, but I'm glad we can get everyone on the line today, because I know a lot of our listeners will be very interested in what you have to say. So speaking of that, let's just dive right into it there, because there's a lot we want to talk about with you. But we'll start back at the very beginning, at least from our perspective. Nearly 20 years ago now, back in 1994, I believe when you were at the London Business School, but correct me if I'm wrong, you wrote a paper that postulated the idea of an interesting, somewhat straightforward yet bizarre and unique new product at the time, that you called, or you referred to in the paper as the log contract. And since then, in the 18 or so years since that paper has come out, many people look back now at the moment when that paper was first published, and particularly people in the quantitative finance realm really refer to it as a watershed moment for the way people look at volatility. And in many ways, it paved the way for products like variance swaps and ultimately what we see today in the VIX product suite and a bunch of other tradable volatility products. Now, we obviously have a number of sophisticated listeners who I'm sure are very familiar with the intimate details of that paper, but we also have a number of very active retail VIX traders and volatility traders who probably aren't familiar with the origins of that paper and that product. So why don't you do us a favor, Anthony, and walk our listeners through some of the outlines of that early paper and maybe explain what that log contract was and where that concept came from.
Right. Well, it was really just thinking about the nature of a call contract, that people buy call options or put options because they like the kinked payoff, that you've got a floor there and then you've got an exposure to the underlying. But the trouble with option contracts is that although when you buy them, they're at the money and they're kind of interesting, or most people buy them when they're close to the money, that over the course of a short period of time, they either become uninteresting because they go deep in the money and you've just got a leveraged position in the underlying, or they go uninteresting for the opposite reason, that they go deep out of the money. So the problem with a call option or a put option is that although they've got lots of optionality, lots of gamma when you buy them, they tend to go out of the money, away from the money over time. So I started thinking about whether one can't provide a contract which always remains interesting over its life. And once you start thinking about it that way, it becomes kind of obvious that you want a payoff which, instead of being two straight lines stuck together at an angle like bent arm or something, you want something which has got a continual curvature. And so you've always got some exposure to volatility, whatever happens to the asset price. And it doesn't take very long before you start thinking of contracts which are, well, I originally thought about power contracts, where the payoff is a power of the price, like the square of a price or the cube of the price. But for various technical reasons, it became obvious that there was one very special power contract, and that was the log contract. And if you've got a log contract, you've got a constant exposure to volatility. And then it became fairly clear that you could trade volatility using this log contract.
Anthony, now I really don't understand that concept that, the log allows you to trade volatility, because, if you were just, let's suppose an index was 100, that log is something like 4.6. And right. And then if it goes up to 110, so, like a 10% gain, the log would be 4.7. And if right. If the price went down to, say, 90, it drops 10%, then the log would be something like 4.5. So it still goes up and down when the underlying index goes up or down. So and maybe it's at a different rate, or obviously it's at the log of that number. But how do you get volatility out of that then?
Okay, so in that example, if you simply delta hedged that position, then you would take out most of the change in the option contract, in the log contract, and what you get left with is a kind of second order term, which is proportional to the square of the price movement. I mean, it's true, whatever sort of option you position you have, that if you delta hedge it, you'll get an exposure to the square of the price movement. What's special about the log contract is that the amount of exposure you get to the square of the price movement is the same whatever the level of the price. So if you hedge out a conventional, I mean, if you buy a call option, you've got a delta, you've got an exposure to the underlying. If you delta hedge it, then you're exposed to the variance of the underlying. But your exposure is much greater when you're close to the money than when you're deep in or deep out. The great thing about a log contract is when you delta hedge it, your exposure to variance is the same, whatever the level of the price.
Now, Anthony, I'm curious, a couple questions here off this original paper. A, why do you think this one paper really became such a landmark event and still is so often cited by people to this day? Was it just because of the novelty of the concept at the time? And then B, why do you think that even though the paper has had such a lasting impact, it wasn't the log contract so much, but really the variance swap that arose out of this research that became the really prominent tradable product out of this?
I think the reason it had a lasting impact was simply that it's the simple right answer to the question. And I think anybody could have come up with that if they'd asked the right question. I didn't. The fact that I focused on the log contract rather than the variance swap which comes out of it shows that I wasn't asking quite the right question, but it was close enough to get a useful answer, which then provided the basis for the variance contract.
You know, it's interesting because this paper wrestles with a problem which in many ways we're still somewhat wrestling with today in the general option space, particularly with those plain vanilla options you cite, where you still have this problem where people are coming into it and they're picking up a position, short or long, whatever the case may be, and they end up with exactly what you describe, either a far out of the money position that is essentially useless, a far deep in the money position that is unwieldy and cumbersome, or something that is hovering at that line that is unpredictable and vacillating all over the place. And so we still are in many ways trying to wrestle with what this paper attempted to solve almost 20 years ago in many respects in the option space.
Yes, I mean, one of the interesting things was at the same time, and to show you about the way I was coming at it, I was thinking about another problem of a contract which becomes out of the money, which is a futures contract. And you've got a similar problem in the sense that when you buy a futures contract, all the liquidity is in the near dated, but then as you come close to maturity, your near dated starts to become pretty unmanageable as it comes close to its expiry date, and you then have this awkward thing of shifting from one futures contract to another. So at the same time as I was working on the log contract, I was also working on an idea which actually Bob Schiller had actually a little time earlier for how to deal with that problem too. But it's not a solution. That was a solution for a problem which nobody has now taken up, whereas the log contract was obviously one which was a question which people really wanted to have the answer to, and which led to the development of variance swaps.
It's interesting. How do you think that, everybody's trying to find that golden goose of volatility hedging and of the variance swap. How effective do you think variance swaps have become at allowing firms to lay off risk and to adjust risk, based on your original idea? Is there more that can be done, is kind of my question.
Yes, I mean, I think there's quite a lot more that could be done. Obviously, we're talking about risks which are traded risks. So, and I think there are many risks that people want to lay off which are not traded. For example, the concerns about the market going illiquid, the risk of illiquidity, is one which is much harder to find a way of trading. But I suspect that the variance risk products are capable of considerable further development. There's obviously a development in terms of the maturity of the contracts. I think that there are some issues involved around what happens when the price changes, jumps by a considerable amount, and the kind of classical approach to it leads to a failure in the hedge. And there's some areas like that. And there's an area which I'm also concerned and working on now, actually, which is on hedging skew risk.
Well, Anthony, even before you get to that, it seemed like you really tackled this problem of jump risk and all of that by sort of proposing to redefine realized variance. Can you explain that a little bit?
Yes, certainly. The simplest way of explaining the maths of the log contract involves imagining a world in which prices move by diffusion, and so you never get jumps, and where variance is computed by calculating returns every instant. Now, obviously, there are jumps in prices, and variance swaps in practice are calculated typically using daily price changes and not continuous price changes. And I was thinking a bit about that, and it turns out that you can use the log contract approach without any change, provided that you redefine what realized variance is. Realized variance in a variance swap would be defined as the squared log daily price change, and then you sum that up and normalize it by time. But there's no obvious reason why you have to take the square of log returns. You can do something which mathematically sounds a little bit more complicated when one describes it verbally, but it's just twice the difference between the log return and the arithmetic return, which is almost identical to the squared log return. It's not quite identical, and it's not quite identical, particularly when there's a large jump. But if you define realized variance in that way, then the replication by the log contract works perfectly, even if you're only measuring variance of daily returns, and even if there are large jumps in prices. So what I would argue is that if you're really concerned about making sure that the variance swap is actually a perfectly hedgeable instrument, then the obvious thing to do is to slightly modify your definition of realized variance. Go away from the traditional one of squared log returns and go to this slight variant. And a colleague, Oleg Bondarenko, has actually proposed this some years ago, as I discovered in 2007, I think. So I'm not the first one on this, but I think it's fairly obvious that if jumps are an issue, this is the sensible way to go.
Yeah, what do you think about some of the other ways, like average true range, some of the kind of like overnight indicators, different things along those lines, as opposed to even dealing with like variance of log normal returns?
I think that working with corridors and ranges obviously makes sense, because the whole philosophy of the log contract requires you to simulate a log contract using traded options, and if you've only got a limited range of strikes you can use, then you have problems in replicating the log contract. And the obvious way around that then is to use to define the variance within the range of strike prices for which there are options available. And that seems a good idea from the perspective of the person who's writing the variance swap and trying to hedge it. It's probably a less good idea from the person who's trying to protect themselves from risk, because obviously it gives you much less protection if and when the price goes outside the range.
Now, Anthony, I'm dying to get into your other research you mentioned about the skew and the skew risk premium. But before we get away from this land of the variance and the variance swap contracts, I was reading some interesting analysis of your early paper, the log contract paper, and they were postulating reasons as to why they thought the the variance swap became the product du jour and not the log contract. The analysis I was reading postulated an interesting theory. I thought I would put it up to you, see what you thought, that their counterintuitive thought was that the reason the variance swap became the product of choice was because it was ironically not as easily or even not at all replicable by vanilla options, where in many ways the log contract could be because of its European payoff and other elements of that contract. And because of the fact that it wasn't at all replicable by vanilla options, the variance swap became the contract of choice and not the log contract. I thought that was an interesting point. What do you think about that?
I think that is interesting. I mean, it seems to me that the other perspective on it is that if somebody has actually got some risk, they actually want to trade the variance. They're not terribly interested directly in the log payoff. The log payoff is great if you're a kind of do-it-yourself addict and want to hedge your risk yourself. But actually, probably the ultimate thing you want to trade is variance, or possibly volatility, and that's why you've got the growth of volatility swaps, which are obviously much more difficult to hedge, but they more directly related to the concerns, the risks that people actually recognize and want to hedge.
Now, Anthony, a topic that is near and dear to us on this show and many of our listeners who tune into the program on a regular basis know we love to talk about tail risk and skew risk and all of the fun variations thereof. We've had many interesting discussions and or debates with our guests on this very subject, so I'm glad you want to discuss this as well, because we're always open to discussing this topic. You recently wrote a very interesting paper entitled "The Skew Risk Premium in Index Option Prices," where you get into this in very, very great detail. And you're also working on, correct me if I'm wrong here, but the concept, or perhaps the desire for kind of building off of the variance swap concept, the idea of skew swaps. Is that correct?
That's right, yes.
So why don't we start there? Just tell our audience a little bit about what your idea and what you're planning for in terms of what a skew swap would actually be. Okay.
Well, I take it that the main interest from a user's perspective is the skew in the returns on say, the equity index over some reasonable period, the skew in the monthly returns. So one's interested in either exposing oneself to or protecting oneself from large moves over the next month, large down moves over the next month in the index. And therefore you're wanting to speculate or hedge the third moment of the return distribution. Just like with variance, you're concerned with the second moment of the return distribution. So with skewness, you're interested in the third moment.
Anthony, let me jump in here for a second. So what you're saying really is when you're an equity investor or an equity index investor, you generally like volatility on the upside, right? And what you're trying to do really is avoid volatility on the downside. So what you're getting at, if I understand you correctly, with the skew swap is that it hedges the downside volatility, let's say better or whatever. You can put words in my mouth, but the downside better and sort of leaves the upside, more alone. So if I understand you correctly, is that kind of how it works?
Yes. I mean, essentially the argument is this: that if I enter into a variance swap, I pay money if variance is low, and I receive money if variance is high. And I receive money if variance is high, whether it's because the market's gone up a lot and has been volatile, or whether it's gone down a lot and been volatile. Now, there may be some people who really want protection against volatile markets when they move down, but is not terribly concerned about volatility when the price is moving up. So they don't want an instrument which simply pays out when there's a lot of volatility, whether it's downwards or upwards. They want an instrument which pays them money when the market moves down and is very volatile, and where they're content to pay when the market moves up and is very volatile. So instead of a payout which depends on the square of returns, which will be large when returns are either very high upwards or very high downwards. They might want a payout which depends essentially on the cube of returns, which will be a large payout when it's a large downward move, and a reverse payout when it's a large upward move. And so that's essentially what one wants with a skew swap. And the question then is how to design a skew swap which makes sense, which is consistent with this. And with variance, you just do it on the realized variance, a swap on the realized variance, which is the sum of the squared daily price changes, or the other formula that I was talking about, which is very similar. The question is what you do with a skew swap. And the first thought is you just do it the third moment of daily returns. But that's actually not going to do you any good. Nobody's really interested in the third moment of daily returns, and the third moment of daily returns doesn't tell you anything about the third moment of monthly returns. It turns out that the thing you ought to, the skew swap, the realized skew, is actually the sum of two terms. It's the cube of daily returns, and it's also a second term, which is the covariance between the return in a day and the change in volatility in the day. And that is the essence of a skew swap. And if you have a skew swap defined in that way, it behaves exactly in the same way as a variance swap, that you would pay a fixed leg and you would receive the realized skewness, and in that way you could hedge yourself against the unexpected skewness in the return on the basic index.
Anthony, that sounds wonderful, but how is that really different from buying a put option? I mean, buying a put option, you're trying to protect your downside. In fact, sure, it's a perfect hedge if the put is exactly the item that you have. So if you bought the S&P index and you bought a put option on the S&P, then you essentially have the perfect variance swap on the downside, and it essentially goes away or just is a cost on the upside. So how would this be different? Better. Well, it's definitely different, but how is it better or
okay.
What's the difference?
Let me put it this way. Supposing I was talking now about variance swaps, you could ask, and I went on the delights of the variance swap. You could then say, well, look, I'm a bit puzzled, Anthony. I don't understand what the difference is between this and buying a straddle, because in the same way you get protected when they're very large up and down moves. And the answer is, yes, you're absolutely right. You can hedge yourself against the return perfectly by buying 1 month contracts, without 1 month option contracts, without going into variance or skew swaps. The only reason for going into variance or skew swaps is if you want something which is continuously got the same exposure to volatility or skewness over time. If you bought an at-the-money straddle, then it would shift in or out of the money over time and would no longer be an at-the-money straddle, and you would stop having the same protection against unexpected variance. Similarly, if you just bought an out-of-the-money put, you would get static protection, but you wouldn't get this sort of dynamic protection against unexpected changes in skewness.
So in many ways, it's a packaging product where you can essentially replicate the best elements of the product without having to go through all of the laborious effort yourself to create that on your own through dynamic hedging and all of the other aspects that are required.
Yes, I mean, just to explain what the strategy looks like, just like a variance swap looks a little bit like buying straddles and continually rolling them so that you're more or less at the money all the time. The skew swap looks like buying kind of risk reversal position and continually rolling that. So yes, it is. I mean, it just can be seen as a dynamic strategy where you're buying out of the money puts and financing it by writing out of the money calls, and then as the price level changes, you roll your contracts so that you continue to have a long position in out of the money puts and the short position in out of the money calls.
That's very interesting because I guess it really boils down to the reality of the situation. When you are hedging, you have an S&P position. Let's say it's at 100 now. Just rebase everything to 100, and you'd like to buy a put option that's 5% out of the money. Let's say that's at 95. So, that works great, but that's really today, because next month the S&P price might have gone up 5%, and now it's at 105, but your put is still at 95. So now, what do you still now, you don't get a 5% hedge. It's now like a 10% hedge because your put option is still back where you bought it a long time ago. So what you're saying is with this skew contract, it kind of adjusts, and now that you're up 5%, it actually gives you this, downside protection from where you are now.
Exactly. In some sense, it stays perpetually at the money. And it does the rolling of the contracts to keep you at the money automatically.
Wow, that's very interesting.
Has this product progressed beyond the paper stage at this point? Have you talked to any of the usual suspects in the OTC realm about perhaps replicating this contract and licensing it or putting it together, or what stage is it in?
I've had mild conversations, but I really feel like an academic, and I'm more interested in getting the idea out there than in actually trying to market it. I think my comparative strength is in thinking up of these ideas rather than in marketing them.
I like it. Spoken like a true theoretician and academic. You want to promote the idea. Promote the idea and promote. I like that. That's we're very focused here on the practical aspect as well, which is why we tend to ask those types of questions as well. But Anthony, this has been fantastic having you on the program. I know we could go on with you for quite some time, but you have to run and we have to go.
Unbelievable.
Before you do go, though, I know since you are talking about skew and tail risk here, I would be remiss if I didn't give you a chance to sound off on a very interesting conversation we've been having with many of our guests over the past few episodes. We've had a number of people coming on discussing different academic papers about skew risk premium and tail risk premium and whether it's overpriced or underpriced given the current market conditions and the way the market currently prices, let's say, out of the money put options in the SPX. And I'm just curious, what is your viewpoint on that very contentious issue? I just came back from RMC. It was a very hot point of contention down there. So I'd love to hear your viewpoint on what, and if the market right now is currently correctly pricing in tail risk, or if we're overpricing it based on these extreme quote-unquote black swan type events that are really outliers, or where do you fall on this heated debate?
The empirical work I've done, which doesn't focus specifically on the prices now, but over the prices over the last 10, 15 years, suggests that, yeah, sure, there's a lot of money for writing. There's a very substantial skew risk premium. That's very clear in the data, that if you write one of my skew contracts, that maybe 2/3 or 3/4 of the price is a risk premium. And there's also a substantial, as we know, variance risk premium. But they seem to be very, very closely associated. And in fact, it seems to be the case that if you started writing skew risk contracts and picked up the premium, and then you started getting worried because on the whole you pay out when variance is very high, so you hedge yourself with variance contracts, the amount of money you give up on the variance contract more or less absorbs all the profits you're making on the skew contracts. So my view of the empirical evidence is that there is a skew risk premium, there is a variance risk premium, but they're pretty much the same thing. They're closely related to each other, and they're not separate things which you can get both of.
Well, here's a question for you. My general thoughts on kind of the risk premium in skew is that it's actually, and in variance, is that it's actually at its most expensive when you don't need it. Has anybody overlaid studies of the relative overall market volatility, so the level that variance swaps are trading, or at the money straddles, or whatever you want to call it VIX, call it real market realized volatility. Has anybody done any studies on how the risk premium pays out when market realized volatility is at or below the mean relative to at or above the mean? Because I've got this running theory that the thing that really inflates the risk premium in skew and in all of that is that it's insanely high after it's already worked. It's just kind of a thought of mine that I've been really thinking about and wanted to kind of know your thoughts on my little thesis.
I think that's probably true, that when volatility has been particularly high, then when realized volatility has been very high, implied volatility goes up more than it should do, justified simply by the fact that volatility is autocorrelated. And clearly, if we've been through a period of very high volatility, it's reasonable to expect that future volatility will be high. But I think I think the evidence suggests that the market overreacts in that way, or that the risk premium is high, particularly when volatility has been high. So I think what you're saying is borne out by the data.
Well, Anthony, we appreciate you joining us today and pushing back your dinner plans to make the Volatility Views show. I know Bob and Mark and I could sit here and chat with you for much longer, but you have to go, and we, of course, have to get on with the rest of our show. But we definitely appreciate you coming on. We'll definitely have to bring you back on again down the road. I can already hear our listeners clamoring and writing in saying, ask him this, ask him that. So I'm sure there's quite a few questions we still have to get to in future episodes.
Thank you very much for having me on the show. I'm very keen to get these ideas out there and see how they work in the marketplace.
Great. Thank you very much.
Thank you. Bye-bye then.
All right, and that's going to do it for our Volatility Viewpoint segment. And now we're going to dive right into our Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and those haunting tunes mean it's time once again for the Crystal Ball segment. This is, of course, the portion of the show where we peer deeply into the murky ether of the future and attempt to divine what the volatility gods hold in store for us. And these days, with realized vol and even implied vol hovering at such low levels, it's sometimes difficult to separate what we discuss in the vol review from, of course, what's going on in the crystal ball, because a lot of what we talk about in the vol review is pretty much going to be, hey, looking for more of the same here, of these low vol levels going forward here in the crystal ball. So I'm thinking we're going to hit on a lot of those same topics today in the crystal ball, but nonetheless, we shall start with you, one Mark Sebastian of OptionPit.com, and I'm guessing you're saying right now that VIX is a screaming buy, and to load up on VIX upside and VIX verticals. That's the call from you.
Oh well, buy May futures. That's the best trade out there.
Yes.
And hold through expiration. Ugh. No. I think that we're at kind of a level here. I don't think that there is a lot of pull up or a lot of pull down. I like the VIX to stay in between this 14 to 16 range for some period of time. I'm expecting a lot of erosion in VXX, and watch that VIX contango. With these ETNs, as we said, there's this new pattern of front month gets crushed, second month gets bid up, bid up, bid up, front month rolls off. We start the new pattern, and then second month gets slaughtered by 2 or 3 points in a matter of a day or two. So be interesting to see if that pattern is persistent.
Yeah, that VIX futures term structure was yet another popular topic of conversation at that risk management conference. There were so many interesting topics. We could really go on at length about all of them, but numerous people pointed out just how the steepness, the incredibly steep nature of the current term structure out there in VIX futures, and how it really is not unprecedented, but almost unprecedented in many ways, and how there were only several other moments in history where the term structure even really approached this level of steepness, and how that really, why that could be coming about, and how that plays into different people's viewpoints of the vol cycle. And
I think it's a combination of traders are buying a lot of skew. Skews relative to the at the money vol. Skew is really expensive, and that is kind of. And then you've got these ETNs. And so the structure of things right now, I think, is bullish. And I do like the market to continue to rally. I really do.
Yeah, this ETP, ETN world that has popped up, let's say, in the volatility landscape has, I think, in many ways contributed to that term structure, because they have created these leveraged short products, and a lot of people are just getting heavily short gamma, heavily short VIX and vol, and so they have to pick up some long-term futures just to hedge some of that exposure, and then they're rolling, and it's just kind of, and as well as you have many annuities out there that are doing the same thing, and so all this combination of these new customers selling vol and creating short gamma positions and then hedging them has really just exacerbated this term structure to these ridiculous levels we're seeing now, where we get to these points where you're right, the disconnect between the VIX cash and the front month future is so ridiculous that it has to go somewhere. And the VIX cash isn't getting bid up anytime soon, so in reality these futures have to come crashing in aggressively, and it's an interesting trading opportunity. And Bob, speaking of trading opportunities, where would you like to start this time, Euro or NASDAQ? Which cone do you have before you, sir?
Oh, well, I have both of the cones, but Euro is just a coin flip. I have no clue. It's sort of average volatility right now.
Bob Hughes going out on a limb, and the Euro.
Okay, well then, we got to pay homage, I think, to Don. So I'll go short.
Wow, an aggressive play there in the Euro. But yes, if you bought vol, I don't think that would be proper homage to Don in any way, shape, or form.
No, you're not allowed to buy vol here. Sold to you. Remember that.
And in the land of Apple plus vol?
What's that?
And in the land of Apple plus vol, what do you see out there?
Well, that's interesting. For the S&P, I still think it's a short, but with the NASDAQ, because of this Apple thing, I'm actually getting a little concerned that it's a little too expensive right now, and that it should come down. I don't think that the world's really taken into account that Steve Jobs was the mastermind of the vision, the visionary at Apple, and he's not there anymore. Sure, the technical people are there, but for the next new product and the next new product, they might have some trouble down.
I concur. Did you read my interview in The Economist, Bob? Yeah. I was in The Economist, kind of concurring with you 100%. I think that there are some people that want to give Apple a 30% forward growth rate need to think twice. And there's a reason why it's not trading at some at some huge multiple, because there's a lot of doubt about how long they can keep this going. Think about this. In 1990, every product that everybody owned was a Sony, right? I mean, think about this. We had when I was 14, I had a Sony PlayStation, Sony TV, Sony VCR. Did they have DVD players in 1990?
No.
I want to say no.
Yeah, you had maybe a VHS or a Betamax. I had a
Sony Walkman, a Sony CD player. And now look at Sony. They're Samsung. They're nothing. And Apple is kind of the same concept. As soon as their technology stops being, the technology stops improving, Apple's done. The same thing that happened with the personal computer.
Hey, Apple TV, baby, it's going to save the company yet again. You watch.
Sold to you on that one. Sold to you. I'm going to tell you what. Here's how dumb I am. I'm going to pay a bunch of money to pay for something that I can get for free through cable.
Well, there you go. That's the future of Apple in a nutshell. Apple TV.
You gotta love Apple in order to buy Apple TV. You gotta officially be one of their fanboys.
So, listeners, Bob Kraus calling for Apple to come down, and therefore NASDAQ realized and/or implied vol to start creeping up again. Then I'm hearing is that your long-term prognostication, Bob?
Yeah, I would. I'd go for the spread. Buy NASDAQ vol, sell S&P vol.
There we go.
I like it.
You heard it here first, listeners. And that is going to do it for the Crystal Ball segment. That's also going to do it for this episode of Volatility Views. We, of course, want to thank our guest, Anthony Neuberger, for joining us on the show today. It was a fantastic interview segment. We'll have to get him on again on the show very soon, because I'm sure a lot of our listeners loved what he had to say and have many more questions in store for him. Of course, I also want to thank my cohorts here, my partners in crime, for joining me on the show. And starting off with you, one Mark Sebastian, a.k.a. Mr. CPass, a.k.a. Mr. Slinky, a.k.a. the man from Option Pit. What is coming up in the land of OptionPit.com that may intrigue our Volatility Views listeners?
Well, it's been a crazy, crazy week, but on Wednesday I'm having Zach Fitch, who's a smart little quantitative broker from Price Futures, come on with the help of Jack Scoville, and they'll be talking about agriculture.
That's your foray into wheat and was it dairy and grains? Which one was it?
Dairy and grains.
Yes,
Zach is probably the smartest has probably the best understanding of milk volatility out there. And Jack Scoville gets the wheat and some of the grain stuff like you wouldn't believe. So that should be a really fun event. And we've got all sorts of stuff going on at the website. Just make sure you come and visit us, www.optionpit.com. And we will be, I'm going to be all over the place. Check your emails if you're an Option Insider subscriber. We sent out, Thursday, a special offer from Mark and I to all Option Insider subscribers to get my options course, my introduction to options course, for less than half the cost of the normal course.
An insane bargain, a Crazy Eddie type bargain, if you will.
Exactly, and it comes with a free month of, this is either good or bad, if depending. It comes with a free month of my daily commentary, so if you enjoy the sweet sound of my voice, great opportunity for you to come and check out what we're doing.
Yes, more Mark Sebastian. There you go, listeners. Always a good thing.
Say.
And of course, Bob, what is going on aside from your daily efforts to get the NASDAQ product suite going? What else is going on over at volex.us that may interest and or intrigue our listeners?
Well, we changed the name of our volatility index to Real Vol. So when you say the VIX went up 10 and Real Vol dropped 2, that's how we're going to refer to it from now on. So the Real Vol is our 1 month realized volatility. Now, we have 3, the 1 month, 3 month, and 12 month historical volatility, but we're labeling the 1 month version Real Vol.
Interesting, listeners. So we have a new branding shift going on, and look forward to the new Apple Plus products coming out from the boys over at Volex very
that
soon.
And milk volatility.
Yes, that and milk. Milk's the next big thing. Liquid milk, baby. I'm telling you, that's where the future is. What was it in Trading Places? It was FCOJ. Yes, now milk. Milk is the future. All right, and that is going to do it for this episode of Volatility Views. We, of course, want to thank all of you out there for downloading and streaming and subscribing to the program and making it such a success and allowing us to bring on this ever-impressive string of fantastic guests. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about vol contracts, please visit www.volex.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volex_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the VolX Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.